How are you now? Broadcasting from the studios of Magellan Asset Management on Gadigal land. It is the Theory of Thing Investment Podcast, Season 8, Episode 1. New name, new ideas, new strategy, new guests here, absolutely. And remember, if it's talked about enough, it's a thing. This show is brought to you by the Australian Mutual Funds Exchange, doing amazing work, being able to give people access to managed funds in Australia and around the world, which is great. Everything in this podcast is general in nature. The advice that is given is general in nature. If it sounds like advice, it's general. Look, I'm not going to specify this any more time. My name is James Whelan. I am an investment manager at VFS Group. I'm a white male, aged 41, wearing a grey suit, white shirt, and a blue tie. I am joined by Heath Moss of HLM Investments. Heath, how are you now over in Adelaide?
Very, very well, mate. We're really busy over here with the AFL gather round. So everyone's coming here from all over Australia, and it's a huge hit last night with the Crows getting off with a big win.
Oh, yeah, I saw that. Absolutely thrashing it. We'll get into the footy at the end. Make sure you've got your footy tips ready.
I've got my footy tips ready.
Okay. Now, this episode is being recorded on the 14th of April, 2023 AD. It is 11:08 a.m. on a Friday Sydney time, and I'll tell you what, I'm a few hours away from checking out for a week. I'm going to be down at the farm very soon, and I'm really looking forward to that. Speaking of Crows and Adelaide, actually, Heath, and speaking just sort of going a little bit off piece here, I got not a stern message, but I got a direct message from David Koch regarding my tweets about Port Adelaide. And I would like to take this opportunity, if I may, to apologise to absolutely no one for absolutely nothing. I still hate Port, and I still think that we were robbed of that game at the end, but I still think that the Swans just lost. But anyway, David, if you're listening, mate, I'll never listen, and I will just keep doing it. But I did get a really good welcome. I mean, the welcome to country before the Swans game was just incredible, and
yep.
I think that I was welcomed there that night. I'm not sure I'm going to be welcomed back by the umpires after my form third row back behind the goal square on the other night. So, but that is fantastic, and I think that we'll get into that at the end. So, my guest today, Emma Fisher from Airlie Funds Management. She runs the Airlie Australian Share Fund, AASF, formerly originally of Nomura, working on sell side, working on sell side. Then went to Fidelity to join the dark side of the buy side, and then over here to Airlie, and has been running an Australian share fund now for how long?
So the fund will have been running for 5 years in June.
5 years in June. Emma, welcome to the show.
Thank you for having me.
Now, let's just get straight into it. Now, Heath, anytime you want to kick in with a question, mate, you go ahead and do it. And we'll just sort of loosely talk about background, strategy, what's ahead for the future, and how you come up with your ideas, which is great. Now, first off, your origin story. We always like to hear about where did the big break happen? Some people say, oh, well, it was actually my dad got me a job with the thing, and that's interesting. Other people say I work from the mailroom up, which is always the story that I really love to hear. How did you crack into this?
Well, my dad definitely did not get me a job. My dad is not. I think he genuinely believes that investing is gambling. We've often said this, and I say, oh, it's not gambling if you know what you're doing, Dad. And he gives me this look that implies he doesn't think I do know what I'm doing.
I've seen people sitting around the roulette table at Crown at 2:00 in the morning who think they know what they're doing as well.
Yeah, exactly. So no, I didn't grow up in a family with anyone that really knew anything about investing. It wasn't really a thing in my household. My mum was a primary school principal, and my dad works in industrial relations.
Mm-hmm.
So I got interested in investing for the first time through my grandfather. He was probably the only one in our family that had any interest in investing. Sorry, I should just say also, I don't normally sound like this. I do have a croaky voice at the moment, so let's hope that holds out. So I remember one time he came in and gave me a Commonwealth Bank annual report, and he had it open to the board of directors, and he said, look how many women there are on the board. I think you could do this one day. I was at uni. I had absolutely no credentials.
Neither did anyone on the board of CBA either. But yeah.
No. I think, no, actually, it probably was before the time that...
this would have been during the Ralph years, surely.
Yeah.
He was a hell of a guy. Anyway.
So
sorry.
No. I didn't know. I didn't even know what an annual report was. Okay. So I wasn't looking at these names. They didn't mean anything to me. but that kind of spawned a conversation of like, what is this? And he was like, well, when you're a shareholder in a company, they send you an annual report in the mail that tells you how the business is doing every year. This is, I'd always had CBA shares. They're the only shares, like he gave them, me, my sister and my brother, he gave us all CBA shares. Yeah. And I remember every now and then I'd look them up in the paper. Remember you used to get all your information from the paper. And we got a dividend check for every now and then.
Yeah.
That was sort of like in high school, my exposure to investing. So he kind of was explaining what an annual report was, and I was like, oh, that's cool. And then I kind of did a little bit more work, opened up a CommSec trading account, bought $500 worth of shares, which was my sort of life savings at the time. I was a checkout chick at Woolies, and just loved it. Like I remember I'd just refresh the page watching my life savings go up and down because I had no idea what I was doing. I think I bought a bunch around that time, so I can never really remember what the first stock I bought was, but like I own like things like Orica, QBE, I think. Like literally, if you'd asked me my thesis, it was, I don't know, I'd heard the name before.
I used to pick them based on the letters, like my wife picking racehorses, really.
Yeah, there was no thesis behind it, and I think
it's as good as a strategy as anything. I suppose.
Exactly. So that's our process, which we'll get into later. So that kind of got me interested. Mm-hmm. So at the time I was studying commerce law, and I really didn't like the law. I found it just didn't really suit my personality. And the way that degree is structured, you finish the commerce part after 3 years, and then you have to do 2 years of pure law. And I kind of felt, look, I definitely don't like this enough to give it 2 whole years of my life.
Yep.
So I dropped the law and switched into finance, like switched my major. And I'd love to say I never looked back, but the reality is actually did pretty poorly at uni in finance. Like I wasn't, like I wanted to learn, I wanted to get better, but it didn't come naturally to me. What came naturally to me was economics. Like I really loved that. I really loved thinking about the economy. I loved thinking about businesses, but yeah, I think because I hadn't grown up with any sort of language around the share market or anything, I wasn't one of those high school kids that was doing the ASX investor competition or anything like that. So it took me a while to really get my head around it.
Neither was I, amazingly. I don't think that there's any direct straight line between someone doing that and actually then ending up in the industry, to be fair. But anyway, sorry.
Yeah, no, I always think, like when I look back on it all, I just think there was a huge amount of luck. It was lucky that I even found out about it as a career. I sort of fell into it all. I went for a bunch of internships. Nowhere would have me. And then I got very lucky. Sort of the last place I interviewed was an investment bank called Nomura. Mm-hmm. And I got an internship there, and that turned into a graduate position that lasted all of 18 months because Nomura withdrew from equities in Australia. So, that we were all effectively made redundant, which, is not a bad thing to happen when you're 21 because everyone else was, obviously really, really upset. Whereas I was like, oh my God, they're going to pay me for 3 months.
You're going to pay me to leave? I know.
I don't have to come to work.
I can make a career out of this.
Yeah.
Some people do.
Exactly. Yeah. So I was, kind of stoked about it. And at that point, I'd sort of figured out enough that I probably wanted to move to the buy side eventually. So I just saw it as an opportunity to kind of be really open-minded about what the next opportunity for me might be. Mm. And again, the role of luck comes up. I was lucky enough that a guy that I'd worked with at Nomura, similar age to me, really good friend, he went to Fidelity. He was raving about it. So I applied to go there as well. I remember my interview with Kate Howard. She's amazing, and she really stood out in the interview as you meet so few women in these positions, and I immediately thought I really want to work for this lady. And Paul Taylor, he was also obviously an incredible investor. So again, I got lucky that they took a chance on someone who really still at that time didn't really know what they were doing. Mm. And it was a great place to learn on the buy side because they have a lot of resources. You're flying around the world. You're meeting with management teams. You're meeting with a lot of portfolio managers that run global funds. A lot of really smart analysts, and you just you're really thrown in the deep end. But I quite liked that. Mm. So I did that for a few years, and then again the role of luck. I heard a friend of mine, absolutely raving about John Sevior and Airlie and saying that they were looking for an analyst. So I put my hand up for that, had a lot of meetings with him and everyone at Airlie. And then Matt joined as well. So I met with Matt, and actually we laugh about it now because Matt then years later told me that his first impression of me in the interview was that I was quote unquote cray cray.
That's nice.
And so we kind of hold it up as an example now of maybe you can't always judge someone by your first impression of them. Because I'm hopeful that he jokes about it now because he doesn't think I'm cray cray anymore. But maybe I'm just a terrible interviewer. I'm not sure.
I'm an absolute savage one. I know what you mean. I actually haven't had an interview since 2009. I've managed to get away with it. UBS 2009. That was the last actual formal interview that I did. The rest has just been on network and people know.
Well, I think the game's changed while you've been away because when I interview people now, I'm always amazed at how smart younger people are these days and how they answer questions that I would not have been able to answer at their age.
Yeah. They're all getting right. Now let's go into Airlie, the business. It actually was. So thank you for that overview of what you're all about and how you got into there, which is good because we get a lot of young people who do want to know about sort of how do I actually start, how do I do this. Hang on. So if you're at Nomura, you would have been there with Marty Wetton.
I was, yes.
Okay. And what was he doing at Nomura at that time? What was he like?
He was great. Yeah,
okay.
He was great.
Yeah. Marty, now head
he was very friendly and I was a nobody. Like you could not be a bigger nobody than me at Nomura. I was 20, straight out of uni, my first job. Yeah. And he, stands out as somebody that was willing to give anyone in the organization his time of day. Yeah. Which,
he's still very much like that.
Yeah, exactly.
Gives us a lot of time. Martin Wetton, head of FX and fixed income strategy at the Commonwealth Bank of Australia. It's so funny that sort of comes around there too, to CBA. The big yellow washes over all of us. Which is good. Yeah, he's a great guy. Always has lots of time. Really good friend of the show too, which is great. Now, let's talk about Airlie, the business. So what's the connection? So we're in the Magellan offices now. And this will be a good overview. So we're sitting in the Magellan offices now. What's the connection between Airlie and Magellan?
Yeah. So I joined Airlie in 2016 and we were a standalone boutique at the time. Matt joined around the same time. So Matt and John had worked together for years at Perpetual. John left Perpetual, started up Airlie in 2012. I came on board, as did Matt, in 2016. And then 2 years later, they sold the business to Magellan. The reason for that was, when you're running a boutique, especially at that time was, compliance in particular, like all this back office stuff was just becoming more and more.
Tell me about it.
Yeah, more and more of an imposition on John's time in particular, and he just wanted to be focusing on investing.
Yep.
So, I guess he took a view that the industry was consolidating and that he wanted to play a role in that. And what Magellan brought to the table was, firstly, the ability to bring a retail product to market, which is the fund that I work on, the Airlie Australian Share Fund. We wouldn't have been able to do that on our own. Magellan have world-class sales and distribution and marketing teams.
Yep.
So that was very helpful. And then all the other back office functions that were really becoming quite onerous for us as a small boutique, they were able to take that all on for us and it just freed up the team's time to focus on investing. So they have delivered on all of that in spades.
Okay, so you mentioned that you launched the Australian Share Fund. We'll just call it the AASF from now on.
AASF, yes.
Not the ARS. But
that is the colloquial term.
You love it. I love it.
Well, we've just launched a small caps company that's the ASCO, so that's the ASCO.
See, that's much better. That's a better acronym than anything else that's going on. That's okay. So with the AASF, so talk about the process of how you come. So you're a what's known as a bottom up manager.
Yep.
And run us through the process that you would have.
Yeah, sure. So we start with the balance sheet, and that's a yes or a no. And we toggle it. Some people will say, "Oh, we won't invest in businesses with net debt to EBITDA below 2.5 times or something." Whereas for us, it's around what's the business model. So if you're a retailer, 2.5 times net debt to EBITDA, that is a highly geared balance sheet. For a business that has a lot of natural operating leverage in it. So for a retailer, we pretty much want to see as close to net cash as you can get. Unless you're something like a Wesfarmers where you're very diversified. Yeah,
Wesfarmers is the exception to a lot of rules with it.
Exactly. I mean, that said, they've got a fantastic balance sheet too, but they'd be about 1 times net to EBITDA, whereas we know the other retailers we own, say a Premier Investments, 400 million in net cash. So that's how we would look at a retailer. Whereas if you're expecting a net cash balance sheet when you're looking at a toll road, that's a really lazy balance sheet. That's not the optimal financial structure for that business model. So we don't have a hard and fast rule for what right looks for us in terms of a balance sheet.
Yep.
It really depends on the nature of the business model, how much of their earnings is outside their control, which is another way of saying how cyclical are earnings.
Yep.
We quite like cyclicals. You can make a lot of money in cyclicals if you time it right. But I think the precursor for that for us is a business that has a ton of cash. So, if you take a point in time right now where I think the consensus view is we're heading into some form of downturn, we have no differentiated view on that. We're not macro investors. I think that as a consensus view certainly appears reasonable given all the data that we can all see. But if you think you are heading into a downturn, you really want to know that you own companies that have really strong financial positions, not only because of downside protection, which is obviously important, but also because in a downturn, businesses that have great balance sheets are going to have a lot more optionality. And I don't think, a downturn, it's not forever. And it's been a very long time in Australia since we've had, a severe protracted downturn. But it's kind of like a bushfire in the sense that you do expose, during a bull market, there's a lot of misallocation of capital. And I think we're seeing that now in little things like milk run the other day going bust, and, businesses that aren't necessarily going to generate a return through the cycle when the price of money isn't free. So a downturn can be quite good for big business models. Take a Woolworths, for example. If the milk runs of the world were able to be fully funded and chip away at what is a very low margin business already and just chip away at the profitability of that, that's a problem for them. So it's a good thing for the incumbent if money isn't free. And so I don't think, the types of businesses that we're investing in, we think they should actually come out the other side of any downturn in a stronger position.
Yep.
So that's the balance sheet. The second and third thing that we're looking at is business quality and management quality. And then the final thing we're looking at is valuation. And I've kind of separated it that way. So there's 4 things we're looking at, but I've separated the first thing of balance sheet because that's got to be a yes for us. And then the other 3, it's really about trade-offs.
Okay.
So in Australia, well, anywhere, but we all know the Aussie market really well. If a company is a really good balance sheet, it's got a great quality business, it's got a cracking management team, and all of that's really obvious to everyone, those are usually the most expensive stocks. The market's pretty efficient. It's pretty good at pricing these things for their prospects. And our fund is not necessarily around finding the best companies in Australia and just buying them at any price. For us, we really want to find situations where those trade-offs look positively skewed to us, where maybe the quality of the business isn't being reflected in the valuation, or maybe, and you wouldn't want a whole portfolio of these, but if you had a couple of turnarounds in there where the valuation is sort of reflecting a very poor performing business for a long time, but there's some sort of reason, whether that be new management or a new strategy, to believe that the business is going to improve.
Yeah, I want to come back around to this. Yeah, go on.
And it's going to re-rate accordingly. So that might be another scenario. So we're looking at kind of just a little bit more complex. Like I could rattle off, we all could rattle off the best businesses in Australia, REA, businesses like REA, Car Sales, Seek, ResMed, they're cracking businesses. We all know that. But for us, often what we'll do is put those businesses on a watch list and then just hope that we get a chance, a hiccup or a big market drawdown, and then they come your way from a valuation perspective. They don't always.
No.
And REA's come our way a few times, and we've been too greedy and missed it every time. So we owned it once briefly, and then like idiots sold it thinking it was overvalued, and it's gone on to ever higher multiples. So that's one way you can play it. It's being patient and waiting until that valuation piece starts looking compelling.
Yep.
But that's what I mean. We're assessing these factors. It's dynamic. Sometimes you do all this work, and this has actually been the story of maybe pre-COVID. You had these ever grinding lower of interest rates for the last decade, and that just saw valuations ever grind higher, and that was quite a frustrating environment for us because you find all these businesses, you do all this work, and then they're falling over at that valuation piece for you because they just look like fair value or they look like overvalued. So the last 12 months it's been very tumultuous, but we're now starting to find, some more absolute value ideas that are looking compelling. So that's kind of how that all works with respect to our process.
So going into the Heath, jump in anytime you want, mate. But I'm just going to keep going if
no
not.
worries.
The just coming together with the idea generation. So you just mentioned if there was a rewrite, a re-rate in a company that was potentially ahead, if you had a part of the business that potentially had been undervalued that might have been turning around, how does the idea for that come to light? Someone's actually got to put that in front of you and say, okay, so the value, it ticks all the boxes on this, but there's this bit in here that's just going to spark it. And this is the pitch and this is the presentation. How does that come to fruition?
Well, we've got a team of fantastic analysts. So the way it works, we are a smaller team compared to some of the larger teams in the market, but that's also by design because having experience I've been an analyst for a very long time, and I've done the waterfront coverage thing where you've got a very small coverage list and you rate everything in that coverage list. And I've done the broader generalist thing where you've got 3, 4, 5 sectors and you're looking at 50 stocks. I personally, for my temperament as an investor, prefer the latter because I think a portfolio manager, they're always thinking about the opportunity cost of investing in BHP versus every other stock in the market, not BHP versus any other resource stock. So I think if you, as an analyst, if you're too narrow, you can sometimes, miss the wood for the trees. Not always. Great analysts, can definitely do the other model. It just didn't work that well for me.
Yep.
So we've structured our analyst team along similar lines where you'll be covering a couple of sectors, 2 or 3 sectors, 30 to 40 stocks. And it's the analyst's job to really be on top of all this stuff and surfacing ideas. The other layer from a top-down perspective is I work with Matt Williams, who's been around for 25 years. A lot of the time, he's kind of directing traffic as well. If he thinks something looks interesting and he wants the analyst to do a bit more work on it, then maybe sometimes it's the ideas flagged by him and then we work on it. I'll give you an example of one, I think, in this turnaround category. So our analyst, Joe Wright, he covers the insurers and we've never owned QBE. Matt's, I don't think he's ever owned QBE in all his permutations of his funds over the years. And we probably would have just kept going like that. It's been the right call not to own it. But Joe really banged the table on it. He said, what's changed here is the new CEO. He's got a very good background. He's come from a competitor, QBE, Beazley, that has a very good reputation. What matters in insurance is underwriting and your attitude towards risk. And old QBE had this view that you wanted to diversify globally so that anything that was happening in any one small people, the lights have gone out.
The lights have gone out. It's fine. It's just because we haven't been moving. That's all. That's right. That's sensilised. It's environmentally friendly because we don't need the room.
Exactly.
Yeah, it's part of your ESG policy.
So the old QBE would sort of try to diversify away the risk of any one jurisdiction blowing up on them by, buying a lot of businesses and being everything to everyone. But what that meant when you were going out and doing these acquisitions was you bought a whole bunch of businesses that had very different attitudes towards risk, different underwriting qualities, and every year you just had something blowing up in your portfolio. And so the business was viewed as a black box by investors. It was very opaque. It was kind of seen as this perennial underperformer. So Joe's work and Joe's conviction there is effectively why we bought it. And we, went on the journey. He took us on the journey of the work that he'd done. We also obviously have to meet with management ourselves. I've actually just come back from 2 weeks in Europe, and some of the meetings that we had were also around QBE, understanding the international business and their reputation in the London market, and also understanding the new CEO, Andrew, his reputation in the London market as well. And he is very well respected by people who've worked with him before. And it's a small industry. Everyone knows each other and people really rave about him. So that was kind of the catalyst, This is a perennial underperformer that investors have just thrown out, but you've got a new guy in charge. He's going to turn around, fix the business. Insurance is really a nuts and bolts business. So you need that kind of nuts and bolts attitude. And when you meet with him, he's kind of like the kind of guy you want to see running an insurance business. Like he seems very sensible. Sorry.
Very boring.
I don't want to say boring. I would say, like a librarian type. Oh.
Yeah. Someone who knows what risk is about.
An actuary.
An actuary.
That's the word I was looking for. An actuary.
Actuary. Yeah.
Actually, I've got a quick question, or it's actually a 2-part question for you there, Emma.
Mm-hmm.
It's you said before, you guys, you're not macro guys, but you do believe there's a drawdown coming. Will you guys look to carry a lot more cash moving forward, then looking for opportunities if there's something around, you think something terrible is going to happen around the corner, or is it purely valuation based that you leave a stock as well? And also, most people are good buyers of stock, or can be good buyers of stock. But the selling side is I think the hard part, knowing when to sell, etc. So is it just a purely valuation based sell side thesis for you guys, or do you play into the macro side as well and say, okay, we think there's a recession coming in Australia, maybe we build up our cash a little bit?
It's a really good question. So with respect to cash, we have a 10% cash limit in our fund, and I typically try to run it between 5 to 6%. And the reason we have a 10% cash limit is because if we could go above that, I would probably get it wrong. And then if I do get it wrong in terms of a big cash weighting at the wrong time, that's going to overshadow any good stock picking that I do.
Good point.
So I think they're two separate skill sets. Being able to pick stocks, I think I've had enough evidence that I can do that reasonably well. I've got zero evidence that I can pick macro, that I can, in fact, I could probably pick the macro, i.e. what's going to happen next, but I reckon I would be wrong every time on what it means for markets. I always go back to that COVID period where if you'd known at the very first time you heard the word coronavirus, if you could have predicted that as many people would have died as they would have, that, we would have been locked in Australia for 3 years, that any of these things would have played out, you would have gone 100% cash. You probably would have taken your money out and stuck it under the mattress, and you would have missed like the biggest bull market of the last decade.
Yep.
So the world is so complex, and all these factors, really interplay with each other. So I just don't back myself to get the call right.
It's that first and second derivative that come from the event, like and which is a big. I mean, that's a big thing in investing to be able to get to that stage. Because anyone, and you see that the media does this a lot, where they say, this is a disaster that's looming. There's a reason why we changed the name of this show to The Theory of Thing, because the media will say there's this disaster that's looming. Look at the disaster. And what everyone's just, we have to short the market, get out, because there's this huge thing that's ahead. It's just like, if we've all just been talking about it and the market is still going, it's in the price.
100%.
It's done. The Theory of Thing is very much in play.
Yeah.
It's now a thing. It's not a surprise. It's not a black swan.
Exactly.
And so it's definitely part of the cake.
Yeah.
So
I totally agree.
Yeah.
I totally agree. And that's why, to answer your question directly, even though I'd say my base case is a slowdown, it wouldn't be a recession, but a slowdown.
Yep.
I'm unlikely to then reflect that in some sort of cash position, because that is the base case of the market. If everyone was like, things are going so hot from here, it's all back on, it's the roaring 20s, baby, and I was feeling like, oh, hang on a second, I disagree with that, I think a slowdown's coming, that might be different, because you might have a different narrative priced into markets.
Mm-hmm.
But the consensus view right now, this has got to be the most well-heralded recession of all time, if indeed it even happens.
Yeah.
So that matters, because consumers have had years now to expect it. And tighten their belts. Doesn't mean they will, but it's not going to come out of nowhere. The headlines are so gloomy right now. So the incremental move isn't going to be from super bullish to super gloomy. It's going to be from super gloomy to a bit gloomier. So I just, and there are other reasons why I'm not a doomsday prepper with respect to what a downturn might look like. And again, take all these views with a grain of salt, because I'm not positioning a portfolio this way, and I'm probably going to be wrong. But the thing that I look at that makes me the most positive is corporate debt in Australia is so low. So if you look at the lead up to the GFC, corporate net debt to EBITDA across the board in Australia was 2.5 times. So when the GFC hit, not only did you have high starting valuations, so two measures of risk, starting valuations and debt.
Mm-hmm.
You had high starting valuations and you had a high level of debt. So the equity market experience was terrible because, take the REIT sector, for example, your experience as an equity investor was determined by where you sat in the capital stack. And we all find out that we rank below debt investors when, the debt investors want their money back and you can't refinance. So the fact that we're going into a downturn, which is an if, but a consensus downturn, heading into it with balance sheets, net debt to EBITDA is now 1.3 times. So it's much lower.
Is this over the 200?
This is the ASX 200 excluding financials and resources.
Got it.
And I exclude those because I think financials are obviously going to really skew it. But and resources, they've generated a lot of cash. That's just, if you include resources, it pulls it down further.
Mm-hmm.
So industrials.
Yes.
Industrial
Okay. Yeah, that makes sense. Okay. Well, sorry, where was it? 1.5?
1.3.
1.3.
1.3. So for our portfolio, which you'd expect because we've got this balance sheet filter, that number is 0.99. So we're even more conservative than the index. But I just don't see a corporate debt build up in Australia. So I think and that matters because we're equity investors. So I don't think that famous last words, but I just don't see a downturn for the share market being anywhere near as protracted or as severe for equity investors as we've seen in some of these big drawdowns over the last, 20, 30 years. But again, I'm not having some bolshy portfolio view on that. That's just my 2 cents for what it's worth.
Bolshy portfolio view. I'm going to write that down. That's cracking. Heath, mate, you want to keep going?
I was just more concentrating on the sell side of things, and do you have any triggers, that you see in a company that say, all right, we've got to take some off the top here and reallocate it? Yeah,
so I'll give you an example of where, I think most people say, oh, we're bottom-up investors, we don't take a view on the macro. Everyone takes a view on the macro. You're implicitly taking a view on the macro in the exposures that you're willing to take in a portfolio. What we don't do is say, I think inflation is going up, so let's just shove the portfolio full of inflation winners. You're thinking more inductively, I suppose. You're saying, if inflation goes up, how does the portfolio look? Who's exposed to that? What's their financial strength situation? Blah, blah, blah. What's their pricing power? If it goes down, you're running the same scenario. So you're just kind of, analyzing the portfolio through that lens. Mm-hmm. So one more macro-led decision with respect to when we sold some things would have been in December, January this year. So if I look at last year, our portfolio, the first 6 months of the year, we had a pretty tough time, actually. We underperformed the market. And what had happened was we'd made a lot of the right call over the last few years prior to that, where we'd had some cracking numbers, was due to owning a lot of consumer-facing stocks because they were generating so much cash and it was going to their balance sheets. And I think people were too quick to get bearish on the consumer sector. And we really got that call right. But rather than taking a lot of that exposure off when interest rates started to increase, borders opened, so we had an alternative of where we were going to spend our money, I always say the most dangerous force in investing is inertia. So rather than connecting the dots and taking some of these winnings off the table, we were patting ourselves on the back. And we retraced some of that, not all of it, some of it. So then to June, we found ourselves with businesses that we own. So I'll give you some examples. Nick Scali went from $15 to $7.50 in June. Premier Investments, similar story. Wes Farmers. We then turned around and added to those because we thought, okay, well, it's not as, we're just not seeing the Armageddon that the market's now pricing in. And that ended up being, I guess, the right call, because the next 6 months we had a cracking time and they were the biggest drivers of that. So then we found ourselves in December and January. You're looking at a business like Nick Scali, it got back to $12.50. And we just thought to ourselves, the reason that everyone got so existentially worried about these stocks, those reasons haven't gone away. If anything, they're probably looking to be bang on in terms of, fiscal cliff, and the consumer's got to slow down from here, and, rates have risen. And so we just thought, probably to take some off the table then. So we really reduced our position in Nick Scali. And some of our other consumer exposures as well. So that kind of gives you, I've managed to pick one, I guess, a sector that I've ended the story with us coming out as heroes, but I could equally give you as many examples of us not coming out as heroes. But it gives you, an example of how sometimes we use the macro to influence our thinking, but it's really more around that valuation equation of what's the value on offer here. Like at $7.50, we're willing to take on the macro. Even though we think it's probably right, we're saying, okay, this is a business with net cash, so it's going to survive a downturn. It's a great business, it's got a long store rollout profile, it's got a cracking management team. So we'll take on the macro here, we'll take on the cycle. That's what's giving us the opportunity. But equally, at $12.50, it's not pricing in a downturn that is probably more likely than not to come. So that's kind of how we think about it. We really use the valuation to tell us what expectations are.
And that's a really good way of putting it. And if you do come back to that same fair value area, where if your fair value is above where the price is, it starts to be a box ticket for you. And if it's below, then it's start to think about what exactly is priced in for the future. Effectively, I've just said what you said back to you. So there you go. No, that's part of the gift.
I find I agree with people that quote me back to myself.
Thank you.
I think, she sounds smart.
That's a great example. Great example.
Cheers for that. Now, moving on, let's talk about. I mean, it's been in the papers, and it'd be crazy if I didn't mention it. So, John, I was pronouncing it wrong this entire time. How did you pronounce it?
Sevior.
Sevior.
My mum calls him John Sevois.
I was going to say John Sevois.
John Sevior.
I've been doing French, and so everything's got a bit of a French tone on it. So, John Sevior is checking out from the industry completely. Legend in the industry. 3 decades, 36 years.
An illustrious career.
And there was a couple of one big fund. So Hester decided that it was going to take the opportunity to shift. What's the view going forward for Airlie without John? And how do you see any more of that coming up?
Yeah. Okay, so I would say, John retiring, there's no story there beyond the fact that he's been doing it for a long time and he wants to he wants to retire.
Yeah.
I won't embarrass him by revealing his age. He doesn't look his age, but, it's the age at which people decide they want to retire.
Yeah.
So there's no story there. And then, so any fund manager always has to be thinking about succession. We're no different. We've always had a plan in place around succession. We have been lucky. We feel, not every organization has the luck to find themselves in a situation where the guy that can take over is, an equal to the guy that's leaving. And Matt and John have worked together for the bulk of their careers. I think John's done it for maybe 3 or 4 years longer than Matt. So Matt's also got 25 years experience, cracking long-term performance. He's an incredible investor. He's a Hall of Fame investor, as is John. So, we're really lucky that we had 2 of them in the organization, and Matt immediately stepped up to the plate because we've always had to have a succession plan in place. We have a new succession plan in place. That's just part of, running a fund manager.
Yeah.
They're great businesses, but they are fragile. They have inherent key man risk in them. So
it's always top of my list too. Whenever any fund that I'm talking to, when I'm going through my allocations, it always comes down to key person. It's one of the early questions that I ask, or one of the ones that I try and drag out. To try and find out.
So so John leaves, Matt steps up as head of equities, I become deputy head of equities, and then again, when I say we've got a new succession plan in place, what that means is every single day we're always making sure that we're thinking about the future. So it's about bringing the analysts up as well and developing them and talking to them about their career goals. We've just launched a small cap product with one of our analysts, Will Granger, running that. So, and that launched 2 weeks ago. So that's sort of how we've tackled the succession. And the newspaper articles about outflows. So Matt runs institutional mandates, John runs his institutional mandates, and then I have this retail fund, the AASF, that Matt is sort of the deputy portfolio manager on.
Yep.
And then, so as you'd expect in a succession event, John's clients were given the option to come across to us and remain with the business. Some of them have elected to do that, and some of them have elected not to.
Yep.
That's the end of the story.
That's it. That is the story. That's the nature of the beast, isn't it? That people are going to come and people are going to go.
Exactly. And, this is, funnily enough, the second time in his career that Matt's taken over from John retiring. This is a retirement, but the first time was Perpetual. John left Perpetual. Matt stepped up as head of equities. Yeah. They lost some FUM. They rebuilt from there.
Yeah.
So that's sort of exactly how we're thinking about it.
Yeah, Perpetual didn't exactly take a huge backward step.
No, exactly. And I mean, I was talking to you this before we started recording, but, at a personal level, I want to do this for decades. I'm so passionate about investing. I love coming to work. I love working with Matt. We have such a great team. We have such a great culture. We're having so much fun doing it. So I want to do this for decades. I want all of our investors to make a lot of money and have a lot of fun along the way. So, we're feeling really good about the future of Airlie.
Okay. No, that's good. I believe you. It's no problem there. Now let's talk about making money for some people. Again, obviously general advice in nature on this one, and you don't have to get specific unless you don't want to. But let's talk about what the future is for the Australian market. And I know there's always going to be some guys just say, "Oh, give us a stock." But what sort of directions do you see ahead for us just going in for the next 12 years. The investable future, as I like to call it.
For the next 12 years. Well,
12 months, sorry.
12 months, 12 years. Sorry.
Yeah.
Oh, why don't I give an answer to both?
Okay.
You know what? When I step back and think about Australia, you know, this view of us as the lucky country, and it just keeps coming true. You know,
sure does.
I was just writing our quarterly report, and so I'm quoting myself disgustingly in saying what I'm about to say. But basically,
you sound like me.
The history of the Australian economy has been one that oscillates between boom and muddle through.
Yep.
It's not a boom and bust economy, or it hasn't been really, because we have some, you know, really important dynamic stabilizers. We're a small open economy with a floating exchange rate, and we sell a lot of stuff to the rest of the world that they want, and they want a lot of it right now. And, you know, commodities, for example, obviously everyone's well across the iron ore story, but if you look at the total value of lithium exports last year, they're coming close to something like 20% of the value of iron ore exports. And 2 years ago, they were zero. Yeah. So again, and, you know, we're pretty nascent in our lithium journey. So again, we've been the lucky country. You know, what happens to be in our backyard is the stuff that everyone is scrambling to get. So you're seeing, even in the paper today, you're seeing the resources minister talking about the government's attitudes towards wanting to build out the battery supply chain. And it sounds, reading between the lines, like there might be some, you know, government support for businesses that want to invest here.
Yep.
And again, I'm really bullish long-term Australia. As I said, I just came back from 2 weeks in Europe, and so we were primarily on a CSL investor day over in Europe, and there was about 100 investors there. And so, you know, you're chatting to other investors, and what was really interesting to me was I got into a couple of conversations with people who live in Australia, who didn't grow up here, who grew up in other countries. And, you know, in chatting to them, I've said, oh, would you ever move back? And all of them, for the various countries that they came from, you know, these are, you know, wealthy Western economies, said no, because the economic situation in that country is so dire, or it's just a better life for my kids here. And so, you know, it was at the same time I'm having these conversations, the AFR is having articles about how we've, you know, really turned the taps back on for migration. But I just think the relative strength of our economy, and what a beautiful place it is to live in the world, we're always going to kind of be able to write our own ticket with respect to migration. And that's a really powerful force, certainly a really powerful relative force as well. You know, when you think of population growth, fertility rates are declining globally. You know, you look at the demographics in China, for example, and compare them to Australia, where, you know, it's not as though the fertility rate is doing much of the heavy lifting, but we've had really attractive population growth as a function of net migration. And I think that will continue. We all build these DCF models where we're modeling out things, you know, for 10 years and then into perpetuity. And so much of the terminal value is driving the valuation of stocks. And we all plug this, you know, between 2 to 3% terminal growth rate assumption that drives so much of the value. And if you ever stop and think about how likely that is to, you know, occur for the next 10, 20 years to drive these cash flows, I think in a country like Australia, where you can probably count on 1.5 to 2% population growth, that makes that a lot more likely to occur. That covers a lot of that assumption.
I hate to talk about humans as sort of things. DCF, yeah. But it sort of does work a little bit like the floating exchange rate that we've got. It will sort of solve its own problem with, you know, if things are going good, everything's sort of, you know, full up and at capacity, then we can sort of turn that immigration down. And then you've got something like now where they actually want to ramp it up, open it up, and let's go. Same way a cheap Aussie dollar will actually help us in the long run, and then expensive will just balance itself out.
Yeah.
Or am I just talking complete nonsense?
No, I completely agree with that.
Now, so yes, it's all just going to be a muddle through sort of situation for us going forward.
That was.
I'm just going to write buy BHP here is the only thing that I'm going to get out of it.
My 12-month pitch is, you know, I think the shorter your time frame, the harder it is to guess, and it is a guess.
Yep.
Guess what happens. All I do is kind of take stock of what's the consensus view, because I think that's going to be the view that's priced into markets, and then make some sort of judgment call on how likely I think that consensus view is to play out. So I'd say the consensus view right now is fiscal cliff. You know, things, we're at the pointy end of the rate tightening cycle. Now's the time where things start to go bump in the night, which is what we're seeing globally with SVB, with Credit Suisse. So we're probably closer to the end than the start of a tightening cycle.
Yep. Well, for sure.
Exactly.
Yeah.
So
it'd be weird if it was going to keep on going. That'd be a real situation.
You know, like, so the RBA paused, but they've paused before and kept going. So I'm just throwing it out there that I'm never too sure about what the next 12 months holds.
Yeah.
There are a lot of really, a lot of X factors that can kind of come to play. I always bring it down to those two measures of risk for me as starting valuations and balance sheets.
Yep.
Balance sheets are looking great right now, so I'm not worried about that. And then starting valuations look more reasonable than they have in the past. Not crazy value though. That's what makes it a bit hard to be too bullish as well. It's the fact that for so long the dynamic for equity markets underpinning things was the Tina effect of there is no alternative. Now there is an alternative, many alternatives, and a lot of them are yielding a lot more than these stalwarts of the ASX and their dividends.
Yeah.
So
which is good.
Yeah, like I mean,
for the 60-40 portfolio that I told everyone to get into at the end of last year. Yeah.
Exactly. Well, when you think about that, right? So you've got your bonds part of your portfolio paying you a almost risk-free return that's attractive. Why do you need that from your equities portfolio? So there's another way of saying, like, I don't want to pick on a stock we don't own, but the Telstras of the world through that lens, I think, look quite uncompelling to me.
Yeah.
Because they are low growth and really all you're getting is a dividend. Pretty much the same story for the banks, actually. The total shareholder return piece of that will probably be from the dividend. I don't really see their earnings going anywhere on a 2 to 3 year view.
Yeah, it's interesting.
So
NIM's maxed out, you think, on the...
Yeah,
okay.
Yeah. And then it's always tough for them to tackle their cost base and get any sort of, get much of a lever that way.
Okay.
So again, like this is not a situation with banks where I'm painting this doomsday scenario of you're going to see this bad debt cycle. I don't think recession is never priced into banks. When we talk about consensus narratives and, the bad news is priced in. If you think there's going to be a recession, if you think unemployment's going to 7%, you do not want to play that through the banks. You could make a case for having a position in a business like Nick Scali because it's going to survive to the other side because of its, the strength of its balance sheet and the quality of the business. But, banks are very levered instruments as we're seeing, in Europe and the US right now.
Yeah. So sorry, go on.
Yeah, so you can tell we own CBA and we own NAB, but we are massively underweight versus the index in the big four banks. But I think you can tell through that positioning that, the fact that we even own two of them, that a bad debt cycle is not our base case.
Excellent. Heath, have you got anything else that's on there? Otherwise, I'm just going to do a quick pitch on this one. We are sponsored by the Australian Mutual Funds Exchange, an amazing product that allows you to have access to mutual funds around the world, here and around the world. It effectively connects to the M Funds Exchange that the ASX is potentially going to be winding down as well. But if you wanted to get access to a fund like Airlie or like any of the other funds that we've mentioned here or in India or anywhere around the world, then go and check out amfex.com and get a login and have a bit of a play around with it. It's a good way to do it. It's not actually direct access to it. It's a CFD over the back of it at an exact 1-for-1. So it's not actually levered. It's an amazing product. It's an amazing thing that they've built.
Yeah,
but it means you can pull up any fund and compare them and see what's the underlying.
Interesting.
Yeah.
Yeah, well, I mean, in the spirit of shameless plugs, I should also say that the AASF is also listed on the stock exchange. So it can be and
that's an LIC.
Well, it's an active ETF.
Yeah. Okay.
So the benefit of that is it's not going to trade at a discount or a premium.
It's bang on the nav.
Exactly.
Yep.
So it's open-ended.
Yes. Unless some fat-fingered financial planner in Adelaide decides to dump it on the market or ramp it up and completely screw up your charts. Which
I dropped my lunch on my keyboard once.
I wasn't naming names, but we all know who it is. And please, a message out there to anyone who's doing it: if you want to do something in an ETF, don't do anything in the first half hour of the day. Make sure that you know the price and don't just go and hit the other side of the spread. Let's just try and keep it normal market for everyone, please. If you don't, go and find an adult and ask them how you're supposed to put the trade on, because there's people who just stuff things up, and we do take advantage of it sometimes. And if you see an ETF that's absolutely trading at completely the wrong price, one of the market makers is stuffed up. It happens all the time. They know who they are. We take advantage of that too. But anyway, that's a whole different story. And that's the Australian Mutual Funds Exchange, which is cool. AmFex, which is great. Now, I'm about to drop my portfolio manager, who has been giving me some footy tips. So, David, you know who you are. Heath, now you managed to go 2 from 2 last week?
Yeah, 2 from 2.
God damn it. Okay. Do you want to try and back that up? I'll go double or nothing on this on tips here. Now, We'll get into this. And so what's your best tip that you've got, Heath?
Really, really simple one this week. I think the Pies to win 1-39. The margin 1-39.
Yep.
Paying about 220, so you're going to double your money.
Okay, that's not too bad. So that's absolutely it. Now, David's shot me. Now, there's things where you just stick with the same PM, the same person who's doing it. I'm about to move some allocation from him. He's absolutely a dud. I'm probably just going to start taking this on myself, which is the equivalent of sort of moving out from a managed account into my own ComSec account because I reckon I could do it better. So he's gone. Here are some tips for you. Dragons plus 6.5. He likes the Bulldogs plus 8.5. The Titans plus 10.5 and Storm minus 4.5 to beat them. I actually like the doggies there, and that's one that I'm going to put the lock on. Doggies plus 8.5 there. That'll be paying about market price 190 because that's the start that he's got on that one. What have you got for us, Emma?
All right, I reckon. So I've got the Swans tonight.
Yes.
They are playing Richmond in Adelaide.
Yes.
And I've got them to win plus 10.
Yes, plus 10. Oh, with the start. Over.
I don't know what I'm talking about.
That's good enough. That's okay.
The short answer.
That's okay. Okay.
That's my tip.
Okay. Because I've got some words for Buddy Franklin the way that he played last week or didn't play last week, and we'll see. And how's Together Round going for you over there, Heath, mate? It's absolutely looks amazing. He's gone. Okay, thanks, Heath.
He's heard my terrible tip, and he's just
he has actually just dropped. He's actually dropped off the call. Okay, all right. I think that's our message that we need to do wrap it up. So thank you very much for that, Emma Fisher of Airlie Funds Management, running the Airlie Australian Share Fund AASF. You can find them on the market if you want as an active ETF, which is great. They're benchmarked to the ASX 200 accumulation index, and they have been beating that benchmark since inception as well, and are just beating it on a 12-month period too. I think it's neck and neck, but over a long enough time that it's all right. Heath is actually back on now, so mate, we're just wrapping it up. So thanks very much for your time.
No, thank you guys. It was great chat. Great to meet you, Emma, and hear about your story. It was fantastic.
Thanks so much for having me, guys. It was a lot of fun.
No worries, and thanks for joining us on the first season of our new show, The Theory of Thing investment podcast. Cheers for that.
Thanks a lot.